Bonjour, mon nom est Daniel Brunet. Good morning, my name is Daniel Brunet. I'm the chair of the Membership and Services Committee. So as you know, the purpose of our association is to promoting retirees' financial security, health, and well-being. L'objectif de notre association est de promouvoir la sécurité financière, la santé et le bien-être des retraités. Alors, je vais dire quelques mots en français, parce que vous savez, aujourd'hui, la langue de la présentation va être l'anglais. Comme vous le savez, l'anglais est la langue des finances. Et pour la traduction des documents qui ont été mis à votre disposition, c'est assez facile, on a pu s'organiser à l'avance. Mais en ce qui concerne un service de traduction simultanée de la présentation, c'est malheureusement beaucoup trop coûteux pour notre association. Alors, toutes mes excuses pour mes amis francophones à ce sujet, mais tout ça la présentation va se dérouler en anglais. So, before I introduce the two speakers, there's two matters to deal with. So the first matter is, as you have seen on the list of the written document that has been provided to you, at the bottom of it, there's a disclaimer. And it's very important that you read this when you deal with the Infomart, our friends at the Infomart on the financial sector. So, on average, most of you have devoted more than 25 years of work to the public service of our country. You work a long time to achieve financial safety and security in your retirement. So now is not the time to make foolish and hasty decisions with your savings. So the association does not endorse any product, any financial advisor, or anyone who is here to promote their services and products. The association has no deal with any of the financial firms, and nobody is offering you a discount negotiated by the association. These firms are here for your convenience, to provide you with an opportunity to explore what they have to offer to respond to your needs, and they will be here until 1 o'clock this afternoon. The second matter that I want to bring to your attention is that you should know that Michael Fine, who is with us, Michael, you can stand up, who was the past chair of the Membership Service Committee, and I have been spending a fair amount of time this year on your behalf, on behalf of the board, searching for a financial service provider ready to provide the best services to the best clients. That means the best advisory service at the lowest cost with reliable financial products. And so far, we have not found any firm who is fully meeting our criteria. None. But we are going to carry on the search. So that gives me the opportunity to introduce you to our speakers. Now, the idea of these presentations is to become more knowledgeable about exchange-traded funds, ETF. Last year, we had Rob Carrick here from the Globe and Mail, financial reporter, who provide an overview of ETF and index investing. And this year, we are looking more carefully at everything you need to know about index investing and ETF. And that's bring me to Warren Buffett. Warren Buffett in his annual letter to shareholders of Berkshire. As everybody knows, Warren Buffett has been identified as one of the most successful investors of all time. And Buffett always compared the performance of his company, Berkshire, to the performance of the S&P 500. And now here's what Buffett said about smart investors and ETF in his annual letter to his shareholders in February 2014, and I quote, "Non-professional investors should not the goal of the non-professional investor should not be to pick winners. Neither he or his helpers can do that, but should rather be to own a cross-section of businesses that in aggregate are bound to do well, and a low-cost S&P 500 index fund will achieve this goal. Both individuals and institutions will constantly be urged to be active by those who profit from giving advice or effecting transactions. The resulting frictional costs can be huge and, for investor in aggregate, devoid of any benefit. So ignore the chatter, keep your costs minimal, and invest in stock. Money, my money, said Warren Buffett, my money is where my mouth is. What I advise here is essentially identical to certain instructions I've laid out in my will. My advice to the trustee could not be more simple. Put 10% of cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund. I suggest Vanguard's. I believe the trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers. End quote. End of quote. So as certain of you know, the compounded annual gains, including dividends of the S&P 500 over the last 50 years, that is from 1965 to 2015, is 9.7%, so almost 10%, compound annual interest, compound annual produce. Now, as anyone following the market these days knows, this year the S&P 500 is up by 4.9%. And this year, the Canadian index, the TSX composite, which is heavily weighted in resource stock, is up by 14.1%. So almost the best performance in the world if you compare, because the price of some commodities like oil and gold is slowly coming back. So there are two external elements in the Buffett quote I read you, Standard & Poor's and Vanguard. And that is why our next two speakers are here today. The first one is from Standard & Poor, and the second one from Vanguard. So that leads me to introduce you to Philip Brizink. Philip Brizink is with Standard & Poor, is the global research and design at Standard & Poor Dow Jones Indices. And Philip is responsible for quantitative research and development of index strategies in multi-asset and equity asset classes. Prior to his current role, Philip spent 5 years in the index management and production group at Standard & Poor Dow Jones, where he was involved in the management of strategy and custom indices. So Philip is a CFA charter holder, and he is a member of the New York Society of Security Analysts and the CFA Institute. So I won't take much more time to introduce Philip. So now, Philip, you have, well, let's say about 40 minutes to make your presentation, and after that, we will take questions regarding your presentation. Thank you. Thank you.
Hello. Thank you very much for inviting me to speak to you guys here in Ottawa. I'm very, very happy to be here. Myself, I'll be speaking only in English, but there should be a French presentation on the right side, and English will be over here. So I wanted to just basically go over what I want to speak about today, and I'll definitely leave time for any questions amongst the crowd here. So first I want to touch on introduction to indexing. What are indices? how do they play a role in the marketplace, and also what the evolution of indices have been. Next, I want to touch on what we call is the SPIVA scorecard. What the scorecard does is compare indices that we provide and compare them to active mutual fund providers. But basically what we want to see is how does the performance compare amongst these broad-based indices to these active mutual fund managers. And lastly, I want to touch on a new index that we launched earlier this year. It's called the S&P Long-Term Value Creation Index that was introduced in Davos earlier this year. This index focuses on long-term investing. It very much stresses companies that are focused on long-term as opposed to companies that may try to meet their quarterly earnings reports every quarter. So first I wanted to start off basic overview of what are indices. It's a measure that represents the value of an asset class or a portion of an asset class. Some examples would be stocks, bonds. We also, from S&P, we provide commodities, we provide multi-asset indices as well. Basically what this wants to do is just represent a portfolio of what a hypothetical portfolio would be for a marketplace. Now, how are these used? A lot of times these are used by financial market participants to understand the state of the markets. So as you can see here, bull market, bear market, a lot of times when people think of it in these terms, they look at what does the index performance do? Or on a day-to-day basis, how did the S&P do in the US? Or how did the TSX do today? A lot of times that's what drives how the market is doing on a day-to-day basis. The third bullet point I want to go over is how can these be used? So these are hypothetical portfolios. You can't invest directly in an index. So there's two main avenues that these are used. So first, it's a benchmark for an active portfolio. So if you have an active mutual fund or an active manager, a lot of times you want to see is, if they say they returned 10% this year, you might think that's actually pretty good. But how does it compare to a benchmark index? Because if a benchmark index performed 20%, then you could say, in relative terms, this active portfolio actually didn't do good. Or vice versa, if a benchmark performed 5% for the year, then the active portfolio actually did very well. So it's very important to think when you're looking at how an investment is performing, how does it perform against something that's a broad-based index that's holding a wide range of securities. And then also, the second point is, and this has been growing substantially year over year for the past 10, 20 years, is a basis for passive portfolio. And what does that mean? There are now financial instruments such as ETFs or index mutual funds that actually invest mirroring what the index portfolio looks like. So if you see what the index is, like the S&P 500, there are a lot of providers that have S&P 500 ETFs or index mutual funds, and they mimic all the constituents in the 500 and also the same weighting as well. Just to give a brief history of indexing, it all really started with the Dow Jones Industrial Average, which was introduced in 1896. So this was created by Charles Dow, and what he came up with is a price-weighted index, and it started with only 12 companies. So what does price-weighted mean? Well, this means that when you weight the securities, because this is an index is a composite of these securities, how do you weight them? So price weighting is basically you're taking a look at the actual stock price of each stock, and then when you compile it together, basically the highest priced stocks have the most influence on the final index value, you could say. And this is still being produced today. Our company does manage this index, S&P Dow Jones Indices, and it's had 30 companies since 1928. And what's special about this is, while the constituents have changed over time, there's been very, very little turnover in what companies are in this index. So this really focuses on the 30 largest companies in the U.S., and it makes very, very few changes, as opposed to something like an active portfolio, which may turn over consistently year over year. This index might make a change every 2 or 3 years. So in 1923, the predecessor to S&P, which is the standard statistics company, introduced a capitalization weighted index with 233 companies. Initially, just because of the data, this was calculated on a weekly basis. So this was every Friday, I believe, they published this number in the newspapers, basically showing how did these 233 stocks perform. And what I mean by capitalization weighted as opposed to price weighted is that this is based on the market value of a company. So the largest companies in the world will have the highest weight in the index. So you're talking about, like these days, you're talking about the Apples, the Googles of the world. And as technology improved in 1926, what actually happened is they started calculating it on a daily basis. In 1957, the S&P 500 replaced this 90 stock index, so the 90 stock index was the actual predecessor to the S&P 500 that we all know today, which holds 500 companies, basically focusing on the largest 500 companies in the United States. And in 1976, this is really when the movement started, as far as, as opposed to having just a statistical measure of the index value as a hypothetical portfolio. The first index fund that was actually investable to normal people, to investors across the world, this was introduced there in 1976 based on the S&P 500. Now, I believe this fund didn't hold every single stock in the 500, but it did hold as much as possible and tried to basically mimic the representation. So you're talking about trying to match the sector representation that you see in the S&P 500. You want to hold the same amount, so there's no biases. One thing I left off here is that's relevant to you guys. So 1977, the TSX introduced the TSX Composite, which is basically the equivalent to the S&P 500 index in Canada, and it's been running since. Currently we manage this index along in an agreement with the TSX Stock Exchange, and that's all comes to today. How much influence do these big indices have on the marketplace? Well, some numbers here: 7.5 trillion US dollars are benchmarked directly to the S&P 500. So this means across the globe, this is how much money that is directly benchmarked to the 500. So this not only means active managers benchmarking to it, but it also means ETFs, index mutual funds. So you can see that this amount just shows how important and how much indices have grown in the last 100 years. And what I want to do is speak a little bit about the evolution of indexing. So I've talked about so far like the broad market indices, which try to include as many stocks as possible in the large cap space, which is typically 85% of the entire available stocks that are publicly listed. So some examples of that would be the S&P 500, the TSX Composite, and then the largest index that we produce, which is the S&P Global BMI, or Global Broad Market Index. So this BMI index is supposed to be all-inclusive, so it has, I believe, over 40 countries across the globe. So we divide it into developed countries, like US, Canada, Europe, Japan, Australia, and then also emerging markets like China, Latin America, Africa, and the Middle East. And really what this aims to do is represent the broad asset class across the globe. It has over 10,000 stocks in it. And what's really beneficial to this is, there's no biases. It includes all sizes of publicly listed companies that are at least $100 million USD in size. And what we also do with this series is we split it up across regions, across different countries. So if you want to see, okay, what is Canada doing? How is Europe performing? Well, there's an index in this family that can tell you quite easily how does this region perform over the last year, or how is it performing year to date. Now these are basically market cap weighted, which, as I mentioned before, they're weighted by the value of the companies. The next step is what we call specialized indices. So these are, taking a little bit more granular approach as far as what stocks are included. So some examples here would be the S&P Mid-Cap 400, and you can see this as a complement to the S&P 500. So this focuses on basically the next 400 companies in the U.S. From the S&P 500, so it's a little bit smaller companies. We also have a S&P Mid-Cap 600, which are going to be small caps companies. Another example would be the S&P Select Sector Indices. So what these are is we want to produce indices that give you the performance of what each sector is doing. If you want, it's very useful information if you basically want to decompose what the S&P 500 is doing. Where are the returns coming from in the S&P 500? Well, these indices will tell you, well, how did financials perform in the last year? How did telecom sector companies perform in the last year? And these are some other examples of the industry too, which is the next level down. So if you think in terms of financials, that's great to know, how our financials performing in general. But we also produce indices that go into, okay, so inside financials, how do banks perform? Or how do mortgage real estate investment trusts perform? Or how do insurance companies perform? These are all rolled up into the financial sector, but these industry groups, if you look at the companies themselves, insurance companies are quite different in business compared to banks. And the latest evolution, which has come about in the last 5 to 10 years, this is a really hot topic for us. There's a lot of news covering these, is what we call factor or smart beta indices. These really focus on specific patterns or characteristics of stocks. And what we like to say is these indices historically active strategies. So strategies that active mutual fund providers have produced for a long time. What these try to achieve is try to indicize in a systematic, objective, and very clear way, trying to replicate these strategies all on a rules-based basis, as opposed to people in a room trying to select the stocks. Oh, I think this is a good company, that is a good company. These are all going to be numbers-driven, rules-based indices. Some examples, and I'll go a little bit into detail on each one, would be the S&P 500 Low Volatility Index. Here in Canada, we produce the TSX Composite Low Volatility Index. It's all going to be the same rules. And what this index does is that it selects companies that have the lowest volatility in their stock price for the last 12 months. And the reason being is that there's been a lot of research that our firm and also firms across the market have have shown is that low volatility stocks, where there's low variation in pricing, these are going to be more defensive stocks. These stocks are intended to basically, when the bear market comes, like 2008, 2009, these stocks with a low price volatility give you some downside protection. So in the case of the S&P 500 overall index, this one outperformed that index by about 20%. So the drawdown with S&P 500 lost over 50% of its value. This index lost only about 30%. And what's important to think about it in terms of that is this downside protection. If you want to go back to normal, so say you started with a $100,000 portfolio and you're invested in the S&P 500, now you're looking at $500,000. For the S&P 500 low volatility index, you're now looking at $700,000. So to get back to $1 million for the S&P 500 low volatility index, you'd only have to gain $300,000 to get back to break even. But the S&P 500, you'd have to gain $500,000. In terms of performance figures, you basically have to gain 100% back, which can be a very substantial number. The S&P 500 Dividend Aristocrats Index, this focuses on dividend-paying companies. So these dividend-paying companies, and these are also companies that have historically increased their dividends over a long period of time. So this isn't going to select companies that have just increased their dividend for the last year. We really want to look at companies that have stably increased their dividends 10, 20 years. And this gives a good barometer that these will do that going forward as well. So this gives you a higher yield than a market cap index, and it also gives you a little bit of downside protection as well, because of the yield is paying out the actual contribution to the return is mitigated if there's a down market. And one more strategy I want to touch base on is the S&P 500 Momentum. So this index is basically looking for stocks that have had high increases in stock prices over the past year. So there's a lot of research that we've put out that basically, and there's a lot of academic research that's been put out saying that if a company has performed very well in the last year, they tend to perform well in the future as well. Okay. Now, I've already covered a bit of this, but I really want to give some bullet points. Why index? Why passive investing? These indexes aren't directly investable, but if you take a step back and think of it in terms of, okay, all investors collectively own the entire stock market. So that means, if you want to win, or if you want to do better than the market, well, there's a loser on the other side. It's a zero-sum game. So if you break down passive investors in ETFs or mutual funds, and then active investors, well, passive investors as a group own a pro rata slice of the entire stock market. And therefore, the other investors, active investors, also must own a pro rata slice of the entire market. And one thing to note in this is, I have a few slides on this a little bit later. Active management is typically more expensive than passive management. The fees that you see across the board, wherever you look, any market, active management, because they're typically going to be trading more, as opposed to a passive investment where you're not going to be having too much buying and selling. Those fees get kind of embedded in the net returns to the investor. So what's important is to look at what are you getting in the end? The total return, which is the price appreciation of companies, plus their dividends, minus what the fees you have to pay to invest in here. So what we've seen is active management is more expensive, so that means just to break even, if you compare it to a benchmark, well, they have to outperform by the fee difference. So if you look at a quote by William F. Sharp, which is a very notable academic, properly measured, the average actively managed dollar must underperform the average passively managed dollar net of costs. And this was published in 1991, which is pretty much ahead of its time as far as the influence that passive investing now has today. But he laid this out in a very concise way 25 years ago. Next, I want to get into the SPIVA scorecard. Just the basic information about the scorecard and what does it do. Well, it measures the performance of actively managed funds versus their respective benchmarks, which are also known as indices, over the near, mid, and long term. So we want to see, how these funds perform over the short term, which is 1 year. What about the long term as well, 5 years? Just as far as, what does this account for? It accounts for survivorship correction. So we don't want to only look at, if we want to look at 5-year returns and do a comparison, we don't want to look at, mutual funds or indices that have only been live today, or, and also we want to incorporate mutual funds that were alive 5 years ago but are no longer available today, either due to mergers or liquidation. A lot of times that's mainly due to significant underperformance. It's an apples to apples comparison. So the universe that we select for active mutual funds, what we do is represent that with a comparable index. We also like to show asset weighted versus equal weighted. What does this mean? It basically means that the largest mutual funds by assets under management will have a larger weight in this universe return. And then what we also want to look at is equal weighted, which is every single mutual fund in the universe has the same contribution to the weighting performance. There's style consistency, and what does this mean? Well, over time there are times where an index a mutual fund will change categories or change what their philosophy is. So 5 years ago they may have been focused on, let's say, growth companies, high growth, increasing revenue significantly, whereas previously they might have been focused on picking value companies, companies that are relatively cheap according to certain financial statement metrics, such as earnings to price or book to price. And one other thing we do is we only select one share class in mutual funds. If you look at mutual funds, they typically offer 2 to 10 share classes. This is mainly due to whether the share class is targeted to an institutional investor, which there's a much larger minimum investment size and the fees are a little bit lower, or versus the retail normal person share class. So this just is an infographic of SPIVA across the world. So this is a report we started first in the U.S. I believe we started in 2002, and since then we've grown to Canada, we've grown to Asia, India, Australia, And some of the most recent ones have been Latin America, which includes Mexico, Chile, and Brazil, and then also South Africa. So we've done a lot of expansion as far as these emerging markets go. How do the mutual funds perform there? There's an argument that in emerging markets, there's less information as opposed to developed countries like Canada and the U.S., where information is freely known. Well, how do these countries perform when there's less free flow of information? So you can see pretty much across the board, all these numbers, if you can see them, is basically telling you how many of active mutual funds outperform the benchmark indices over the 1, 3, and 5 year period. And you can pretty see across the board. The last number here is in teal is the 5 year, and you can see that there hasn't been the majority of mutual funds have underperformed. Japan is the only exception where it's 50-50. Now I want to get into the SPIVA scorecard in Canada. This report actually was released in the last week. So this is very, very new data. We're very excited, and there's been a lot of press on this. And this is as of June 30th, 2016. So what we're doing is we broke out Canada into 7 main categories. So these are the 7 categories that have the largest number of active mutual funds. So just to quickly go over it, we want to look at Canadian equity, which is represented by the TSX Composite Index. We want to look at small and mid-cap equities in Canada, and this is represented by the TSX Completion Index, which is basically the next stage of companies that are smaller than companies that you can see in the S&P Composite. There's a Canadian dividend income focused category, and this is compared versus the Canadian dividend aristocrats. Because the U.S. and Canada are very big trade partners and we're very close together geographically, there's actually a lot of funds here that look at U.S. equities. So we compare that to the S&P 500, and as you can see, we don't want to compare the S&P 500, which is normally reported in U.S. dollars. We convert the performance to Canadian dollars, so it's apples to apples comparison, so there's no bias in currency conversion. We have international equity, which is the S&P EPAC large mid cap. What this index is basically the developed countries across the world, Europe, Australia, Japan, without the US and Canada. We have global equity, so this is pretty much everything. So we look at the developed large mid-cap index. And then we also have one last category, which is one of the smaller categories, but this is Canadian focus equity. So this is managers that focus and give a big allocation to Canadian equities, but also give exposure. They want exposure to different countries. So what we do is we combine a few indices into one, TSX Composite, the S&P 500, and then also the EPAC index. So what this table shows you, and the next few slides, there are a lot of data and a lot of numbers. And I won't go through every single data point here, just general observations. You can always refer back to it, I believe, if you guys have copies of the presentation. What we did is we looked at this universe and compared it from 1, 3, and 5 years, short, medium, long term. So what you can see is on the first column of data here, how many funds outperformed the benchmark. Well, across the board, the majority of funds underperformed the benchmark. And this is, just as a note, this is net of fees, and the indices are total return indices, which means it doesn't just include the price accumulation, it also includes the dividends as well. Because this is, as an end investor, this is what you'd get in your portfolio. and over the long term, which is really what we like to focus on, because short term, while there can be sometimes good outperformance in other regions or other categories, to outperform index in 1 year, that doesn't necessarily indicate skill. That may just be due to simple luck. So over the long term, how do these perform? You can see, for the most part, across the board, there's drastic underperformance. So if you want to see, if you want to pick a mutual fund in Canada, how did it perform over the last 5 years? Well, nearly 3/4 of these mutual funds underperformed the index. So if you look at that, you can say most likely you'd be better off just investing in the index, unless you're lucky enough or skilled enough to choose the right manager. One very interesting tidbit here for the U.S. equity funds: 0 funds outperformed the index. So you'd be better off simply just going with the S&P 500 related product, because there's no benefit to investing with an active manager. Yes. Sure. Yeah, sure, no problem. So just to run through it, so Canadian equity, the outperformance number was close to 29%. So 71% of the funds underperformed the benchmark. For small cap, mid cap, where there's potentially less information, there's less coverage by research analysts, this is close to 49% of active mutual funds outperformed the index. For dividend and income equity, it's at 13%. US, like I said, is 0. International equities is almost 14%. Global equities are close to 7% of funds. And likewise, the Canadian focus equities are 7.69%. And like I said, in general, these are all less than the 1 year outperformance numbers. And this is really telling that, these 1 year numbers could have been just due to luck. Yes, a question? Yes. That's balanced out because what we do is we convert it to Canadian dollars, and since all the active mutual funds are reported in Canadian dollars as well, so there's no currency effect basically that you'll see. This is just strictly, in the same terms. How do these companies, even though this is really targeted to Canadian investors, we're looking at apples to apples, same currency. How does the end result, what would you get in your portfolio? It's 0% of funds. And the universe, I believe, for this one is over 50 active mutual funds. Yep. So the end return, it does affect the currency fluctuations, but we're not looking at, we're not necessarily, because we're converting it, it doesn't matter how the currency has fluctuated over time. The 500 is going to be, they're both going to be focusing on the same universe of companies. So the currency really doesn't pay too much effect in here. And just as a note, we take out like hedged versions. So we want to look at companies that are going to be investing in the 500 companies. While currency does definitely affect the total end return, especially how the exchange rate has changed over the past 5 to 10 years. Right. Yeah. And the previous slide, just as a note, I believe I said this before, this was as of June 30th, 2016. And what we like to show also is, these reports come out every 6 months. So mid-year and then also year-end. What we also like to show is, well, if you look at the current report, which was released last week, and I'd be happy to share that with anyone. If you give me your contact information, it goes into a little bit more detail, a little bit more commentary. What I also like to show is, because we've basically released this report since 2012, what are the numbers back then as well? So we're not really taking a point-in-time comparison like the previous chart. We have the data going back, every 6 months. What this slide shows here is, what the outperformance of each category is as of each end year. So you can see it's pretty consistent across the board. There aren't very big jumps. There aren't years where, a category of mutual funds have significantly outperformed the market. And you can see that they're pretty, across the board, there's a lot of underperformance. And just as a note, so this December 2012 number, this is 5 years of data. So this goes back to, during the financial crisis, which is, at times where, there's an argument that, active management, tactical management can actually, do much better for risk mitigation. Well, if you look at it, this actually wasn't the case. Most of the categories were between 5 and 20% outperformance. This slide, this goes into, does the fund size impact the net returns of the mutual funds? So what you can see is here is I broke out the 7 categories for 5-year returns, and we calculated it in 2 different ways, as I alluded to before. So there's asset weighted, which is, the largest funds have the most weight, most contribution, and then equal weighted. So what's interesting here in Canada is for all 7 categories, actually the largest funds did do better than the equal weighted universe. So what you could say here is that, the larger funds, the bigger teams of mutual funds like the Fidelities or the TD funds, which are usually considered to be more sophisticated, well, they did do a little bit better across the board in performance. And next, what I wanted to do is touch base on the SPIVA United States. I find this to be quite relevant because there is a lot of investing in like the 500 here. And this report has also gone back a little bit further. So we first published this report in 2002. So now we're on about our 15th year of giving this report out. What's also interesting is that we also report 10-year performance numbers because we have more data. We can report 10-year performance, which, if you're looking at long-term investing, 10 years is really more ideal. So here we break out US SPIVA. There's a lot more categories just because there's a lot more mutual funds in the U.S. I think the universe is over 3,000 mutual funds. So what we do is we break out the what we call the 9-style box of indices. So what does this mean? We break out large cap, which is the 500, mid cap, which is the 400, and the 600, which is the small cap. And then within each index, we like to break it out by growth, core, and value. So growth companies are going to be companies that are growing significantly as far as revenue goes, and then value are companies that are, relatively cheap based on financial ratios. So it's interesting to look at the results. Overall growth mutual funds have done poorly compared to the other style boxes, but the story is basically the same. There's been significant underperformance, both short-term and long-term, of these mutual funds. If you look at the growth for the large cap, only 1.41% of funds have outperformed the S&P 500 Growth Index. And then the core, which is going to be the S&P 500, you're looking at 1 year outperformance of 18.75%, and then 10-year of 11.79% outperformance. So nearly just 1 in 10 funds actually outperformed the S&P 500. We also like to report international equities. So we have global funds, international small cap, and emerging market funds. A lot of times, the general notion is that active management can do better in, markets like EM or international, where there's less information, there's less stringent reporting standards. So you can see here, our emerging market funds, they actually outperformed the benchmark for the last 1 year. On average, 58% outperformed, but over the long term, only 18% outperformed. Another thing that we add to the U.S., just because it is such a large market, is looking at fixed income funds. It's a very important category if you want to diversify just from equities. What about fixed income? So we like to compare, government, corporates, municipal bonds, mortgage-backed securities. There's a lot of data that goes into this. So most of these comparison indices are from Barclays, which has historically been the standard benchmark provider in the U.S. And what you can see is there's a lot of mixed results depending on what you're looking at. Fixed income is very diverse. So if you look at like a government security, not many funds can do well. But when you're looking at like corporates or a blend of government and corporates, you do see some short-term outperformance. Another thing to look at is loan participation funds, which are leveraged loan funds, focus funds. You can see outperformance in the short and medium term, and then they still don't do too bad in the longer term, 5 years. Another report that we give out right now, only in the United States. We are looking at expanding this to other regions. This is a more recent report that our research team puts out. But what we want to show here is, regardless of how many funds outperform the benchmark, this takes a little bit different spin on it. What this does is, for very similar categories that we present in the SPIVA, is there persistence in outperformance for the mutual funds that actually do well? So we break it out into the top quartile, which is the top 25% performing funds, and then also the top half. So what we want to show here, and this is 3-year data as of March 2016. So we take the universe of mutual funds. So if you look at the top part of the chart here first, this is the fund counts. These are the top quartile funds that are top 25%. So, and that's based off of, I believe, 3 years of data, those 3-year returns. What we want to look at is, okay, so how do these perform over the next 2 years? Are they still doing well or no? Well, if you look at from March 2014 to March 2015, and this is all relative to these quartiles, so these numbers, this isn't 25% of funds, these are the percent remaining. This is, we start out with 100% of the funds that are in the top quartile. How many remain in the top quartile in the next year? Well, you can see pretty much across the board, it's all less than half. So for the all domestic funds, only 30% of the funds that did well relative to their peer universe still remained in the top quartile. So this is very important to see that the trend is, these mutual funds may perform well for a certain time period, but the sustainable outperformance decreases significantly. And if you look at March 2016, which is the latest data we have, only 7% of these funds remained in the top quartile. And I think one of the most striking numbers here is for the all small cap funds. 25% remained after 1 year in the top quartile, but only 0.68% of the funds remained in the top quartile in March 2016. So this gives you a very powerful information that just because a fund did well in the past, they don't necessarily do well in the future. One more thing I want to touch base on when we're looking at like active versus passive mutual funds is the impact of fees. What we can see is, in general, active management is more expensive than passive funds. We put out a report last year that looked globally at different categories. What we wanted to show is what's the average fee ratio of active funds, and what's the average fee ratio for passive index funds or ETFs. So most relevant here, Canadian equities, the active fund is over 2%. So the fee they charge, the fee that they're taking out of the net return to you is over 2% per year. So out of every $100, $2 is taken out. And you can see as the amount grows, that's a very substantial amount of money. Passive funds in Canadian equities are 0.95% average expense ratio, and that's the difference of 1.19%. And the last column here, this is the cumulative impact of the fee differentials for 5 years. So if you take the average expense ratios for every single year, and then you compound it, what differential is that? Well, so for 5 years, if you invested in an active fund versus a passive fund, the compounded effect is over 6%. So for 5 years for active fund, just to match a passive fund, they would have to outperform it by 6% just to break even. Now for the U.S., which generally has smaller differentials in fees, the fees are generally lower. You can still see for U.S. large cap the difference is 0.5%, 0.48%, and that's still cumulatively 2.42% difference. In emerging markets where the expense ratios are much higher, there's less competition, there's much more difficulty in trading. Like in Chile, the average expense ratio is actually 4.5%, so you're losing almost $5 out of every $100 that you're investing in the passive funds. It's still much higher than other regions, but it's relative to active funds, it's almost 2% less. You can see over 5 years that net result is 10% difference. And the last thing I wanted to touch base on is a new index that we introduced in 2016. It's called the S&P Long-Term Value Creation Index. It gets into a lot of different rules, but basically what we tried to do here when we created this index is come up with both qualitative metrics and then quantitative metrics that focuses on long-term investing. We're not trying to come up with an index that's short-term based. Oh, how is this doing over the last month? How is this doing over the last quarter? What the construction does is use metrics that are have been known to create long-term creation of wealth. So what we do is we break this out by qualitative metrics, which is done by one of our partners, which is Robeco Sam Economic Dimension Score. Robeco Sam historically has been very well known to do sustainability investment research, so we partner with them since they're the experts. Really, what this score does is it's looking at the company's management system for long-term risk mitigation. So you're looking at their boards, how they're set up, how many independent board of directors, what risk management tools they have in place, what tax strategies they have. So we're not looking at anything as far as short-term performance. This is really doing a business viability, and they send out surveys to thousands of companies. And since this is very well-respected, companies take this very seriously. The public companies take this very seriously. Now, to bring in a quantitative metric into this index, what we use is long-term operational excellence. So what we do is we came up with a concept of quality. What is quality composed of? It's going to be composed of profitability. How much money can a company make as a ratio to how many assets they have? So it's a relative number as opposed to absolute number. If they made $100 million, is that good or bad? You really don't know unless you look at how big the company is. We also look at balance sheet accruals. This is really looking at how good of a quality these earnings are. So really what we want to look at is, it takes away all the, financial accounting tricks that some companies use and employ. This takes that all away by looking at what this really focuses on is taking away any kind of accounting assumptions, and we want to look at how much cash is the company producing. We don't want to look at if they take a depreciation, which can affect profitability. That really doesn't. That's not a sustainable thing that they can do every single year. We want to look at how much cash, how much quality as far as cash is. And then one other thing is you could leverage. This is financial leverage, which is a company's total debt to equity. This is really looking at how risky a company is doing as far as if a company has too much debt, that's a cause for concern, especially in extreme downside markets. If a company is stable and doesn't have too much debt on their books, this is an indicator for a company that can withstand bull markets or bear markets. I'm sorry. So what we do to construct this index is we combine both. So we're looking at companies that basically are the top half of both metrics, and we combine them just on an average score basis. And then we select the top 150 stocks by this combined score. So this looks at a global universe of stocks. We also have this for individual countries as well, but this is a global basket. And one other thing to point out is we break this out into vintages, which isn't necessarily the easiest thing to explain for some people, but you're taking a basket for the last 3 years, and then you're equal weighting each of those 3 baskets, because we really want to look at is long-term performance. We want to look at these metrics are going to be how are they doing over the last 3-5 years as opposed to just the last year. We want to see sustainable, good companies. So just to give a little bit of performance numbers, like I said here, this was launched in 2016. We're looking at a very broad universe of companies because these scores are available for 10,000 plus companies across the world. And as of, I believe this was as of September 2016, it has 244 stocks. So this isn't a very, condensed basket where you're looking at, stock-specific risk. If one stock in the index does poorly, well, that's only one stock out of 244. So you have some diversification benefits. And the main target, which I alluded to before, is investors that want to invest in companies that manage current and future economic and government risk. Some performance numbers here to the right. I'm comparing it to the global large mid cap. You can see that the combination of both of these actually leads to a healthy outperformance over the long term. For 10 years, you'll see the global large mid cap is 5% annual return, and the LTVC index is 8%. So you're looking at outperformance versus a benchmark where there's no biases or no screens for high quality companies. You see a 3% per year outperformance. And a tracking error, which is how different is it from the benchmark, over 10 years is 2.89%. So you can think of this in terms of how active is it relative to a broad-based benchmark. This number, to keep it simple, is this is relatively low. So you're not taking a big divergence of risk from investing in something like this as opposed to a broad-based benchmark. One other slide I'd like to point out, and this plays along the lines of long-term versus short-term investing. What I wanted to compare here is the performance in the last 5 years of this LTVC index versus the S&P U.S. Activist Interest Index. So a little bit of background on the Activist Interest Index. This basically selects selects companies that have heavy activist investor influence, as far as you think of like the Bill Ackman or George Soros, which go in and invest in public companies that typically aren't doing well, and they go in and try to make things better because they buy a large shareholder, they try to get board seats, they try to do a lot of changes to the company. They like to say that's good for the long term, to make a lot of changes, but a lot of times they don't really have the company in mind. They have the mindset of wanting to get paid a lot of money. So you can see, there's been times where, like in 2014, there's been a significant divergence where activism did really well, but if you can see from 2014 to end of September, what you can see is actually they've done quite poorly. So this is saying, these activist investors, which try to pretend to be, the absolute experts in turning around companies, making companies better, while they showed some great performance in the short term, over the long term, their persistence has gone down to now it's basically even. And that's it for my presentation. I'm happy to take any questions you may have on the presentation or anything else related to index investing. Yep.
Move the microphone. There's 2 microphones on both sides. Yes, sir.
I was wondering if S&P provides forward-looking expected rates of return for these sectors.
I'm sorry?
Do you provide forward-looking expected rates of return for the different sector indices?
No, we do not. We're not an investment advisor. we don't try to predict the future. So we don't do any sort of future projections. We look at history and what's current. We try to be unbiased as far as that goes.
The other question I had was about taxes. Tax efficiency of mutual funds versus passive investing.
Mhm.
Do you have any comments on that?
I'm not a tax expert, so I can't really comment on the tax efficiency. The one thing is, mutual funds typically take into account all the taxes and everything in their net asset value, which is what they report, and because there's a lot of trading involved, they can be subject to a lot of taxes, whereas because the basic structure of ETFs, there's not much turnover, you're going to be subjected to a lot less capital gains taxes because you're not buying and selling constantly.
Okay, thank you.
Sure.
I've always tried to remain on the alert to see if the TSX was overpriced and at any point in time, and maybe I should be reducing my equity exposure. So the main thing that I've always looked at was the price to book of the TSX. Do you have any thoughts on that?
We don't really look at is it overvalued, is it undervalued? There's been a trend in the U.S. and this is probably the case in Canada as well, where the price to book, and also another very common thing to look at is price to earnings, has gone up consistently. That might be in part just due to the bull markets that we've seen in the last 5 years or so.
Thank you.
Yes, Philip, my question is about the report that came out yesterday from Goldman Sachs, and it said that the 2016 return will be okay. It's been doing quite well so far. I think you were speaking mainly about the US market, but 2017 will be much lower, lackluster. How much credibility you as a professional advisor put into these types of reports? And do you think it's Goldman Sachs is doing all their trading and then putting out their report? What's your view on this?
Well, and just as a note, I'm not a financial advisor, so I can't give financial investment advice at all. But I'll talk a little bit about that. Pretty much every single bank gives out the projections of the future S&P 500 index value or what the markets are going to play. What I've seen historically is that they constantly revise their numbers, which for me is a little bit of telltale sign of their confidence level and their projections aren't very high. But this is something that they like to put out. They try to basically be thought of as the experts in the industry. And these are all banks. Every single bank, at least in the U.S., projects the S&P 500 future index value, but it constantly changes. There's very, very little confidence in predicting the future. If you could predict the future, then these companies would be making a lot more money than they are now, even though they do make a lot of money.
Sir?
Just to venture, the American election is not far away now, and you've used the term confidence level.
Mm-hmm.
That's relevant to the American election too.
Yes.
So I know you might not be able to do very much about this question because it's the future, still 2 weeks in the future.
Yeah.
And being 2 weeks in the future, it's fairly close.
Mm-hmm.
So maybe your ability to comment on this would be more in this regard.
Yeah. I can't say too much on that. I think there'd be a lot of concerns if one candidate was elected versus another. But as far as confidence goes, I think across the board, all the projections are for one candidate to win, the confidence level is like 95% now. So that's, the market does definitely take that into account. That is a very important factor when they're looking at, how will the market perform. But the confidence level is quite high as far as who's going to win, so there's not much concern or uncertainty, which could cause a lot of reaction in the markets. The markets as itself now, because the confidence level is high, there isn't too much instability in the markets from that.
Of such an election, a result might be.
The result of the high candidate not being elected, or
You can comment on
I'm
both
not
if you
sure.
wish.
I'm not too sure. Hopefully, we won't have to find out. But the markets are definitely taking into account that one candidate is going to win. So everything's built in. All the information is built in, despite it being for the future. The market is taking into account one candidate winning.
So with this note, we'll thank Philippe very much, and remember one thing: the market predict against the Brexit last June.
That is true. That is true.
Now, thank you very much, Philippe, and we'll see all of you at 11:15.